Hi friends, welcome back to the channel. In today's video, I will talk about my view on the stock market volatility in the past 2 weeks. I will also share my strategy with regards to how I handle the market volatility. Let's jump in. Okay, we all know that the market volatility in the past 2 weeks is the result of fear of rising interest rates. Let's start from the basic first. What is bond yield? Bond yield is the returns an investor gets from investing in bonds. Bond yield is not the same as deposit account. It is just a piece of paper issued by the borrowers, and on top of that paper is stated the coupon rates, the frequency of the coupon payments, and the maturity date. Bonds could be issued by government, known as Treasury bonds, or it could be issued by corporates, known as corporate bonds. Once the bonds are issued, they could be traded among the investors, just like the shares of a company. Whoever that bought the bonds will become the creditors to the bond issuers. When we say bond yield is rising, actually it is not like the bank is increasing the interest rates. Even the coupon rates are still the same because the specifications of the bonds have already been determined when the bonds were issued. What actually changed is the traded price of the bond on the market. So what happened in the past 2 weeks is that the bond price has been collapsing. So bond is an instrument whereby all the future cash flow, including the coupon payments and the maturity payments, have already been known. When the bond price drops, it implies that the yield from the bonds has increased and vice versa. Why bond yield is important and how does it affect the stock market? Treasury bond yield, also known as the risk-free rate, is one of the most important factors that affect the financial market. Warren Buffett explained the importance of Treasury bond yields in determining the stock valuation by saying this: any investment is worth all the cash you are going to get out between now and the judgment day discounted back. There are two ways the Treasury yield could impact the valuation. The first one, Treasury yield will affect the cost of capital or the financing cost. For example, if you could lend your money to a government by buying Treasury bond, say at 2% yield, how much yield would you expect if you are going to lend your money to a corporate? Is it going to be higher or lower than 2%? Of course, it has to be higher than 2% because Treasury bond has no default risk. How much higher depends on the creditworthiness of the borrowers. If you are going to lend your money to an airline, probably you will charge higher because the risk of default could be higher due to the pandemic situation. Say you are lending at Apple at 3%, just 1% higher than the Treasury yield. Now imagine that suddenly the Treasury yield increased from 2% to 4%. What would happen to the bonds issued by Apple? The yield would increase together because investors would always demand a yield that is higher than the Treasury yield. Hence, under a rising yield environment, companies that will need to issue bonds to fund the company or to refinance maturing bonds, they will need to pay higher interest costs, which then would negatively impact their net income. The second reason, which is probably more important, is that Treasury yield will affect the valuation multiples of the companies. Let's say we have a company that has an annual profit of 1 billion. How much would you value this company at? Is it at 10 billion or PE of 10, or at 30 billions or PE of 30? When investors assign a valuation multiple to the companies, besides all the factors that are specific to the companies, for example, the total addressable market, the future growth rate of the companies, the quality of the management, etc., they also would consider the opportunity cost. Imagine they could invest in Treasury and get a yield of 5% versus at 0%. Of course, when the Treasury yield is at rock bottom, investors will have higher tendency to invest in stock market. Now, when more and more people are aware that yield is rising faster than they thought previously, the share price will have corrected downward. Now, should you worry about the rising yield? My short answer is that probably not. I'll provide 3 reasons why we don't have to be too worried about rising interest rate. The first one, fiscal stimulus. US Congress has passed the 1.9 trillion COVID rescue package and is now before the Senate. They will get the bill passed probably with some minor tweak. 1.9 trillion is a huge figure. Investors worried that this flood of money will cause inflation to increase in the future. Inflation is bad for fixed income because that will reduce the real returns. Now, from company's perspective, this is actually a good news. If the company that you own is offering good products and good service, this is definitely a good news. Imagine that people will have more money to spend and these monies will be eventually absorbed by the businesses. Those who receive stimulus check are not going to put their money in banks. They will either spend it, which is good for the business growth, or they will put the money in the stock market, which then pushes up the price. The second reason is COVID-19. I still remember when the COVID cases were increasing at a rapid speed last year. I used to track the new cases every day. Fast forward to today, has anyone still tracking the numbers closely? If yes, you will have noticed that the number of cases have came down quite sharply since the beginning of this year. Vaccination program has continued to ramp up, and Israel and UAE already have more than 50% of their populations vaccinated. In Israel, for example, the symptomatic cases have reduced significantly after vaccination. So it has proven that the vaccination is effective across population. This is definitely a good development. Once cases have reduced, people would be able to carry out more economic activity, and this will boost the economic growth. People spend more, companies take in more revenues and hence more profits. Of course, this would not shown immediately in companies' income statement. We will have to track the financial result throughout the year to find out. The third reason is let's pay attention to the messages from Federal Reserve. Last week, Federal Reserve Chairman Jerome Powell already indicated that the easy monetary policy will be ongoing and they are not going to raise interest rates soon. This is a direct quote from Jerome Powell. The economy is at a long way from our development and inflation goals. Fed will therefore to support the economy with near zero interest rates and large-scale asset purchases until substantial further progress has been made. If we look at the Fed balance sheet, we can see that the Fed is still enlarging their balance sheet, pumping more liquidity to the market. Same goes for the M2 money supply, it is also still increasing. What this means is that there are still plenty of liquidity in the market. Yes, there are some cautious sentiment in the market right now. I personally think that this is good for the financial market over the long term. In the past couple of months, the market was quite heated. For example, it was so easy to raise SPAC, and even before the SPAC was able to negotiate a deal, the share price have shot up significantly. Also, in the penny stock market, you can see that companies with little or no fundamentals saw their prices soaring, as if fundamentals are not important anymore. Some cooling down in the market is always good. Let the short-term traders exit the market, and let those over-leveraged close their position. Then the stock price will come down to a more sustainable level, and we as the long-term investor could buy at a more attractive price. Next, I will talk about my strategy and what I plan to do. Okay, first, I will do nothing. You have seen my long-term portfolio before. Recently, I have added to my core holdings including Apple, Microsoft, Amazon, and TSMC. I will probably wait until next month's salary come up before continue to go shopping. I know that whenever market is panicking, there's always this urge to react. I also experience such urge. If your holdings are long-term holdings and these businesses are going to do well in the future, then you will realize that you don't need the share price to go up to have the validation. Remember this quote from Warren Buffett, if a business does well, the stock will eventually follow. And also this quote from Charlie Munger, the big money is not in the buying and selling, but in the waiting. My suggestion to you is this, if you have some cash to deploy, you may allocate a portion to buy now, with the expectation that the price may still drop lower. This is fine because no one is able to time the market perfectly anyway. If you are overly nervous about the stock market, then you can just step away. Just uninstall your brokerage app and do something else. Come back a month later. If 1 month later the price has come down, then you can buy the companies that you like at an even cheaper price. If the price has rallied after 1 month, that is also good for you because you already bought during the dip. The final message that I want to give is that market volatility is always a good time for us to train our temperament. If your portfolio size is 50,000 and your portfolio recently suffered a loss of 5,000, this amount of loss is definitely painful, but imagine that the kind of volatility that you will encounter when your portfolio has grown 10x from today's value. Once you hit that 10x value, this 5,000 is just a normal fluctuation for you. So make sure that you have a long-term perspective and just stay invested. Invest safe and see you in the next one. Cheers!